Hey everybody, Professor Lee here, and today I want to talk to you about the most valuable credit available for undergraduate college students. So if you're working on your bachelor's degree, you really need to pay attention to this. This is the American Opportunity Credit. The American Opportunity Credit, it was passed by the legislature in order to incentivize people to get their bachelor's degree. And what it is it's a $2,500 credit per year per student. So up to $2,500 for undergraduate students. You can only take it 4 years, and this is to motivate people to go out and get their bachelor's degree, but it's potentially worth up to $10,000. Is every student going to get a total of $10,000 over 4 years? No, but you potentially could. This credit is based on your net qualified education expenses. So what you're going to do is take whatever tuition you paid plus any required book costs or other required fees, and you're going to subtract any scholarships or grants that you received. That net number is used to calculate the credit. I'm going to go through an example so you can get an idea of what that would look like. Where do you even get that information? Well, your university is required to issue you what's called the Form 1098-T. And here's an example for Sarah Johnson, a hypothetical taxpayer, for her 2023 1098-T, which is reporting her tuition and her scholarships from the year 2023. In box 1 has her payments received for qualified tuition and related expenses, and then in box 5 we have her scholarships and grants of $5,000. You can see that book costs are not included on this. Some of them may be built into that box 1 tuition cost if it's paid directly through student fees. Other books that you bought through Amazon or at the bookstore or wherever, you need to keep those receipts and keep track of them in order to add them to this cost. Let's look at how the credit's calculated. So starting with calculating total qualified education expenses. Again, what this is box 1 from that Form 1098-T, that $9,970. We're going to add any other required course materials. And I usually go off of what's required in the syllabus. Okay, a lot of times a computer, a laptop isn't required, so I'm not using that for this credit. Okay, but total qualified expenses, we have $10,296. But we need to net any scholarships and grants received. So that would include federal Pell Grants or any tuition scholarships. In this case, for Sarah Johnson, her net qualified education expenses is $5,296, and from that number, we calculate our credit. The max credit is based on $4,000 of net qualified education expenses. So if you're above $4,000, your max credit really maxes out once you have $4,000 in expenses. The credit isn't $4,000. Remember, I said it's $2,500 per year. Not every student's going to receive $2,500 even if they're above $4,000. And the reason is of that $4,000, you're going to get 100% of the first $2,000 and then 25% of the next $2,000 of expenses. So there's that $2,500 potential credit you could receive. $1,500 of that credit is non-refundable. What that means is, as a student, let's say you don't owe any tax. Your standard deduction offsets any of your taxable income, so you don't owe any tax. You wouldn't get that $1,500. Non-refundable means it can only offset tax that you owe. So if you owed $500 in tax and you had a non-refundable credit of $1,500, you could only take $500 of that non-refundable credit. The more income you have, the more tax that you owe, the more beneficial this credit's going to be. That's another reason why when parents claim their college kids as dependent, meaning the student isn't self-supporting, then a lot of times parents owe more tax, so they could get the non-refundable and refundable portion. If you're an independent student and you don't owe much tax, you still can get $1,000 refundable, meaning even if you owe zero tax, you can get a refund for that $1,000. So students every year can receive thousands of dollars in these credits. There are reasons why they're missed. For example, I had one student who, when I taught him about this credit, he had missed it for the prior 3 years. So we ended up claiming it in the current year, and he had missed it in the prior 3 years, and his parents actually had claimed him as a dependent, so it was almost $2,500 per year, about $10,000 that he received in 1 year. It was incredible. In the next video, I want to talk about why so many students miss this credit.